So today we're going to go over Chapter 9, which is on receivables, accounts receivable, and notes receivable. So the first part of today's lesson, we'll talk about accounts receivable. So when you're in a business, you're going to not always get paid when people owe you. And so here are some clues to recognize that you might not get paid. So your customer maybe is past due on their payment, or you try to give them a call and they don't respond to your phone calls, or maybe they file for bankruptcy or close their business, or you're not able to get a hold of them or you can't locate them. And maybe you have to send it to a collection agency. Well, at this point, you have an accounts receivable sitting on your books as an asset, which is a debit, and it might be time to just take it off if you think that you're not going to get paid. So we would remove accounts receivable with a credit. But there's several methods on how to calculate our bad debts, which are accounts receivable that we're not going to collect. So there's two methods I'm going to go over with you today. The first is the direct write-off method, which I think is the easier method, and it's used for tax purposes. And really, when we find out somebody's not going to pay us or we don't think we're going to get paid, we debit bad debt expense and we credit the receivable for the amount that is due. And the credit to accounts receivable is removing that placeholder on our balance sheet that says we're waiting to get paid, because now we're not going to get paid, so we take it off. The second method is the allowance method, and this is used for financial statement purposes. And the allowance method is not actual debts that are bad. It's an estimate of debts that will go bad. And we have two ways to calculate this estimate, either percentage of the sales, or we do analysis of our accounts receivable. So this is what we're going to go over for accounts receivable. Here are some examples of journal entries for our direct write-off method. So let's say here's our example. We have identified a customer who owes us $4,000 and they haven't been returning our phone calls, and we determine it's not collectible. So the first thing that we're going to do is write off the bad debt. And we're going to do this by debiting bad debt expense for the $4,000 and crediting accounts receivable, which is a decrease to accounts receivable for that $4,000. So now that account is zero. Another thing that could happen is they could pay us. They could come back later and say, okay, now I have the money, but we already wrote it off. So if somebody comes back and pays us later after we've written off their account, then we have to reverse this first entry, and we're going to reinstate their accounts receivable. So we're going to just do the opposite of entry 1 and debit accounts receivable and credit the bad debt expense, which is where we're increasing our accounts receivable now. Once we've increased the accounts receivable, then we could collect the cash that they paid us and credit the accounts receivable, and now it's zero. So this is where accounts receivable is zero. So those are three direct write-off entries. Let's say we just get partially paid though. So here's an example of a partial payment. So we are owed by our customer $5,200, but they only paid us $1,200, and that's all we're going to get. So we're going to write off 4. So the first thing to do is, I always like to do cash first, because we know we can debit cash for $1,200, and we know that we have to remove all $5,200 because we're not expecting payment any longer. So you're going to credit all $5,200, and the difference is going to be a debit to bad debt expense for the 4 that we're writing off. So that is the direct write-off method. The second method is the allowance for doubtful accounts. So we're going to use the allowance method, and we have this new account that is new in Chapter 9 called the allowance for doubtful accounts. So it's basically a bucket of, just in case somebody doesn't pay us, we've created this allowance. This is a contra asset, and it's going to hang out with accounts receivable on the balance sheet, which I'll show you in a minute. So here's an example. Let's just say our estimate for bad debts this year is $10,000 based on, we're going to look at past history and decide historically this is what our estimate is going to be, $10,000 for bad debt. So we're going to make an entry at the end of the year and create a bucket for just in case. We will debit bad debt expense for the 10, even though we haven't identified anything that's bad yet. We go ahead and debit the expense. And then we credit this new account, allowance for doubtful accounts, which is our bucket. It's going to be on the balance sheet, hanging out with our accounts receivable as a credit balance. Okay? And then the following year, so that's at the very end of the year, we create our bucket. And then the following year, we actually have a bad debt. Let's say it's $4,000. We have that $4,000 write-off. And so we're going to then remove that bad account for the $4,000. So that customer's not going to pay us $4,000. We remove the account receivable. And instead of debiting bad debt expense here, we're actually going to be debiting the allowance because now we're taking it out of the bucket. And our entry on December 31, that is when we hit bad debt expense. So we don't hit it again. We just take it out of the bucket. So now let's see what this would look like on the balance sheet. So let's say we have accounts receivable on our balance sheet of $4,000 or $15,000. So that's how much we have on our list of people who owe us. And we've made some adjustments to our allowance account at the end of the year, last year, 12/31 of last year, we put $10,000 into the bucket. And then just now, we took $4,000 out of the bucket. So that means there's $6,000 more in the allowance account at this point. So we took out $6,000. So there's a new concept here, net realizable value. So because allowance for doubtful accounts is a contra asset and it hangs out with the debit balance of accounts receivable, then the difference we're going to call net realizable value, which is accounts receivable minus our allowance for doubtful accounts, and that is our net realizable value. This is very similar to what we do with our fixed assets, where we have an asset we purchased and we have accumulated depreciation for the amount of depreciation we've been taking that keeps adding up, and the difference between those two is net book value. So net realizable value is very similar. Let's work an example. So here we have our example. We have accounts receivable $5,200. They paid us $1,200, and we wrote off the remaining $4,000. So we're going to debit our cash for $1,200 and remove all of the accounts receivable because we're not going to get any of it, even though they only gave us $1,200. And the rest of that debit is coming out of the allowance for doubtful accounts this time, not bad debts. That's because we are now using the allowance method. If we were using the direct write-off method, we would have debited bad debts here. So to reinstate, so these are similar entries to our bad debt write-off. To reinstate, we will just reverse our allowance in our accounts receivable for the amount we get later. So we would add back the $4,000 and put the allowance for doubtful accounts back in the bucket. And then when we get the cash, we will debit cash and credit accounts receivable. So the main difference in this one is that instead of using bad debt expense, we're using allowance for doubtful accounts. Okay, so I've just shown you how the allowance method works, but I didn't show you how we calculate this estimate yet. So I'm going to show you how to calculate the estimate. There's two ways to calculate an estimate. The first is percentage of sales. So percentage of sales, oftentimes in a problem, you're going to see it 1% of sales, or you might see 1.25%, or you might even see it 3/4 of 1%. So you need to know how to put these percentages into your calculator. So here's some examples of how you would translate that into calculator form so that you can multiply that percentage times the amount of sales. So let's do an example. We have a company that has accounts receivable of $1,975,000. They have a balance in their allowance for doubtful accounts of $19,670, and they have $28 million in sales. So what we need to do is, let's say our estimate, this company uses 0.75% as their estimate based on what has happened in the past. And so we will take their sales, multiply it times the percentage, and we will come up with the estimate for bad debts. And then we will record the entry just like we did previously, which is at 12/31 year end. So we're going to record bad debt expense of $214,125 and put it in our bucket allowance for doubtful accounts. Now, there is already a balance in our allowance for doubtful accounts of $19,670. That just means we didn't use all our bucket last year, and we just added more to it. So our new balance in our allowance for doubtful accounts is $233,795. So that is the new balance in that account, but we hit bad debt expense with our estimate that we calculated. Okay? The other method to calculate allowance for the allowance method, our estimate 2, is we're looking at what we want our balance in the allowance count to be. Okay, so our example is here. We have a balance in our accounts receivable of $43,000. We have an allowance balance of $1,500 on the credit side, and our sales are $500,000. So this second method to estimate our entry is called the analysis of accounts receivable. So what we're going to do is we're going to pull our list called accounts receivable aging. An accounts receivable aging list tells us how old our accounts receivable is. So we have $10,000 that is current. So that of the $43,000 that people owe us, 10 of it happened in the last 30 days, 5,000 in the last 2 months, 20,000 in the last 3 months, and 8,000 of it are older than 90 days. People have owed us for quite a long time. So what we're going to do is we're going to estimate at each level of the aging how likely it is that this allowance or this account amount is going to be bad. So since these $10,000 here are new, there's a low probability that we're not going to get paid. So we say only 1% of that $10,000 won't get paid. And 2 months, it's only 2% likelihood that we're not going to get paid there. And then 90 days, let's say 7%, and then we probably won't get 10% of anything older than 90 days. So all of these percentages are really going to be whatever the company thinks based on their past experience with these customers. And then we'll multiply it out. So 10,000 times 1% is 100. 5,000 times 2% is also 100. 7% times 20,000, that's 1,400. And then 8,000 times 10% is 800. So based on all these percentages of these debts going bad, or likelihood that these debts are going bad, we're estimating that 2,400 will be bad. So that's going to be the amount that we want in our allowance account. So when we're using the analysis of AR, what you calculate as your estimate is the balance you want in your accounts receivable. So up here, we said that the allowance balance already had $1,500 in it. Let's look at the T account. Had $1,500, and we want it to be $2,400. So then we have to back into what our adjustment needs to be in order for our allowance balance to be $2,400. So estimate 2 is different. We're calculating what is our allowance balance. We're going to say $2,400. So the difference here is $900 So then that's what we're going to make our entry for at the end of the year. Bad debt expense, $900. Allowance for doubtful accounts, $900. So those are all the two methods for recording or writing off bad debts, and then two estimating calculations for how to calculate the allowance. Now let's move on to notes receivable. Now, all of this is in your book. I just wanted to make sure that you know all of the different terminologies related to notes receivable. Notes receivable are like accounts receivable in that our customers owe us, but we're going to let them take more time to pay us. So you need to know what a maker is, the payee, face amount, issue date, maturity date, what the term of the note means, and what the interest rate is. And then we will use this information to make journal entries, and so do make sure you read over that. So one thing that you need to do is, and it seems kind of silly, but you need to know how many days are in each month. So if I have an issue date of March 1st and a maturity date of May 31st, how many days is that term of this note? Well, there are 31 days in March. April's in the middle here. So there are 30 days in April, and there are 31 days in May. So this term is actually, these are 92 days of interest that will accrue in this note. And you need to know that because we're going to have to be calculating interest, and we use the number of days to do that. So how we're going to calculate our interest owed is we're going to take our face amount times the interest rate, and then times the term over 360. Now I know there are 365 days in a year, but your book really simplifies these calculations by using 360. So all of your homework and quizzes and your exam and in the notes here in this lecture, we're going to use 360 to calculate our interest. So here's an example. Let's say we have a 12% note. So that means 12% is the interest rate. 30 days is going to be the term, and $6,000 is the face amount. This is the amount that was originally owed. So to calculate the interest, we're going to take $6,000 times 12%, which in your calculator will be 0.12, and then we're going to multiply that times 30 days of the note, the term of the note, over 360. So try this in your calculator. You should get $60. What's really important to say here is that this first part of this calculation, 6,000 times 12, is the annual interest amount. So you're always going to be given an interest rate in the real world when a bank gives you a loan, a car loan, a house loan, credit cards. Anytime you see an interest rate, that's the annual amount. And so we first calculate what is it annually, and then the second part is breaking it down for the number of days that are in the note. So here are your journal entries for this note. The terminology is, for the first entry, you receive the note. That means that we get a piece of paper from our customer that says they promise to pay us back. So usually this is because they have taken too long to pay their accounts receivable. So we're going to remove their account receivable and put on, with a debit, a more formal note that says, okay, not only are you now going to pay us $6,000, but you signed a document that says that you will, and you will pay me interest as well, because you don't pay interest with accounts receivable. So the first thing you do when you receive a note is you take off the AR and you put on the new note. Then, whenever they pay the note, you have to not only include the $6,000, but also the interest. So here is the note receivable that we're going to be removing because now they paid us. The interest revenue, so the $60 is what we just calculated, is the interest on this note. That means the total cash you will debit is the interest plus the principal, or the face amount that they paid back. Let's do another example of calculating interest. So we have an 8% note, 90-day term, $12,000 face amount. So what is the interest on this note? Let's do this another way. So let's say $12,000 times 8%. That's going to be $960. Well, that's the annual interest. We don't want to know the annual interest. We want to know 90 days worth of interest. So you would take your 960, divide it by 360 to get your daily amount. So that's $2.66 per day. And then you multiply your daily amount times the number of days. So 90 days, that's $240 on this note. Okay, let's look at last entry. Let's do another entry example. So we have a note with a issue date of November, and it's for $43,000, 6%, and the term is 60 days. Well, 60 days here is actually straddling a year end. So from November 18th to January 11th is 60 days, but we're going to have to record some interest at our December 31 financial statement. So let's figure out how many days are in this year. If you know that there are 30 days in November and 31 days in December, that's 49 days. So from the 18th to the 30th, and then all 31 days in December, that's 49 days, and then there are 11 days in next year's interest. So if we run all of this in our calculator, you should come up with $351 of interest for 49 days and $79 of interest for 11 days. So for the total 60 days, that's $430 altogether. But we have to put this interest in this year, in this year's income statement, and the 79 in next year's income statement. So let's see how we would do that. On November 12th, we received the note. So we're going to put on the $43,000 of the face amount and take off the account receivable they haven't been paying us. Then at 12/31, we have to make an accrual for the interest revenue for this year. So we're going to say it's receivable because we haven't received it yet, and that's our placeholder, and interest revenue to make sure that we get that revenue in the income statement. And this placeholder is on the balance sheet. Then, the day we get paid, so next year we get paid on the maturity date, what we're going to do is we get the cash, not only for $43,000, but the additional $430 of interest. We're going to remove the note, record this year's revenue, and then remove the receivable. So this is where we're removing our placeholder, and this is where we hit our income statement for this year's interest. So here's the line of the years. So here's revenue for this year, and here's revenue for next year. So you're using that interest receivable as a placeholder to show the interest over two different periods. Okay, so this was a little bit longer video, but we had a lot to cover in Chapter 9. Do make sure you read the chapter and go over all of the examples that I've provided for you in the module.